Hey everyone, thanks for hanging around. I always love doing these things, so hopefully you're still excited and still interested in hearing some more trading information. One thing that's very important to me anytime I talk publicly or do any of these webinars is that I try to leave you with something that actually might make a difference. A lot of thought goes into you having something that you can walk away with. So I'm going to hit a bunch of different things. I'm going to give you a bunch of different information. Of course, you can ask questions at the end. But keep in mind, that's what I'm trying to do. I'm trying to provide you with something, hopefully, that's useful. And the title of the presentation today is Beating the Market. And that in itself, hopefully, is a takeaway for you. And then we're going to talk about weekly pivots and how using weekly pivot points can maybe help you do something fantastic. Now, these are going to be hypothetical numbers. Do I trade this system? Yes, I do trade it with live money, but we're looking at some back testing. We're looking at some facts and figures. I do everything I can to try to give you accurate. I put trade costs in it. I try to be worst case scenario anytime I talk about a trading system, but keep in mind they are hypothetical and please don't risk any money you can't afford to lose. All right. Part of the presentation is beating the market. This is a big rant of mine. I'm going to keep ranting about this until every single person at least has heard the counter argument to the market and index funds and stocks always go up. We're going to talk about that. I'm not going to talk very long because I do want to get to the system. I've got a lot of info today. I don't just want to complain about the market. Oh, the market stinks. Don't invest in the market. Do better. Be a trader. Well, it's one thing to complain, it's another thing to show a solution. We're going to have some solutions for you. And I'm going to try to show you a portfolio, a system, then put it in a portfolio. And we'll talk briefly about whether it's robust or not, right? It's one thing for me to show you something. It's another thing entirely if it works or it's going to work tomorrow or if it even makes sense, right? So we'll hit all of that and more, all right? It's not a question. You don't need to type anything in, but it's a question I ask to a lot of people, and that is, does anyone use index funds? And my goal, like I said, is that it's no. I don't. I remember the day when I first met with a financial advisor. I remember how scared, how intimidating, how vague, how esoteric everything was. I'll never forget that moment. And I want to try to spread the gospel of that everyday normal people can do better than just slapping their money into an index fund. Okay, but you realize index funds are now almost half the market, right? Index funds are taking over the universe. There are trillions of dollars in index funds. There are smart people that walk around telling each other, well, I'm rich, I put my money in index funds. And it's just like, yes, sir, yes, ma'am, that's exactly what you should do, right? Well, why? Why is this pervasive? I mean, you've heard this, right? Why is index funds or just buy the market? Just buy and hold the market. Well, it's smart. You can hear millionaires / billionaires tell you, well, you got to save your money, you got to invest in the market. It's safe. Investing in the stock market is safe, right? Because the market always goes up. Have you seen the studies? Have you seen the white papers? Right? It makes this presentation I'm giving tonight irrelevant because you can't time the market. No one can. So what I'm about to tell you in the upcoming minutes is all garbage, according to the index fund industrial complex, right? You can't time the market, and they'll show you studies. To me, they make no sense, but they'll show you studies. So you can't time it, and the market's efficient. Do people still believe this? I think people still believe this, but I don't think it's true. And like I said, smart people tell us to put it into index funds, okay? And there's examples that time heals all stock market wounds. You just got to be committed. You got to be committed. If you're only committed to the stock market, you'll win in the end. And like I said, my presentation is useless. Festival of Traders is useless. Trading conventions are useless. Everything is useless. Why? Because this is why. I believe it's in a very, well, I don't believe, I know it's in a very famous book. I don't want to say it, don't want to disparage anyone, but this is the chart that basically has started the craze, the revolution. And this is from just the 1920s, December 1926 through 2006. That's 80 years, right? Check my math, always check my math. I try to double check it, but I believe that's 80, right? Okay. Yes, it's tough, but look, it made it through the depression and then things go up. Wouldn't we like any trading system you hear at the Festival of Traders to do this? I mean, shoot, the stock market does this, then what are we all doing here, right? So this is it. This is why. This is why you put your money into index funds. This is that same chart. But when you break down these charts, and I don't want to say lies, but these misrepresentations, you start seeing things that go awry. Want to see one? Oh, here's one. This magical chart that goes all the way up and up and up and up and up, that is assuming we put all of our dividends back in. And I don't know about you, but maybe I need dividends. Maybe I can't just put all my dividends back into the market for 80 years. Maybe I need my money. Did you know that? Did you know that chart was, you have to reinvest all your dividends to get that chart? Because this is a chart if you don't reinvest your dividends. If you actually need money, if you just say, okay, I'm gonna buy an index fund. Oh, look, I get dividends. This is the best. But you spend those dividends, look at this. Decades of underperformance. Decades. Oh, and when you're done, look, that's a whole lot different. You see how powerful dividends are? So first of all, takeaway, if you're going to do index funds even after I talk to you, please keep the dividends in, or you may make like 1% a year, right? 1.5% per year is what you make. Were you curious? All right, let's go back one. You see all those years underperforming back since this is 1928, right? 1.4% or 1.5% per year. And it's not really important, it's kind of boring, but see this chart, right? If we start in 1928 rather than 1926, it's 2/3 less, just in case you care, right? So this chart that made everyone buy index funds, basically, if you shift it 2 years to the right, it's 2/3 less money, right? But the cool part about that was 1.5% per year, right? Now remember, that's an 80-year period, right? I'm almost done with my rant, but I had to tell you, this is a rant, a chart that you never see. This goes back to the 1800s. It is 80 years, exactly the same. This is the stock market. They computed the prices of the 80 years before, right? 1926, this is where the other one started. Well, this is 80 years before. And can you see this? It starts here and it ends lower. Stocks always go up, not in the 80 years before. How come we never see this chart? How come nobody talks about it? How come Vanguard or whoever sells index funds or Jack Bogles doesn't say, the stock market always goes up, except sometimes you might spend 80 years and it doesn't go up at all. In fact, you lose money, okay? So I have other facts and figures that we're gonna skip through, but if you invest in the stock market, even with your dividends in, here's a 30-year period, flat, 30-year period, flat, 30-year period, flat, right, 64 to 94. There are at least 3 30-year periods where the stock market makes no money, but we're supposed to just buy index funds because that's what you're supposed to do, okay? So even if it's perfect, even if you invest all your dividends, there's still 30-year periods where it doesn't make any money. Oh, and while you're not making money, there's always 50% or more drawdowns. In the NASDAQ, there's a 75% drawdown, right? 80% drawdown. Anyway, to end my rant, takeaway number 1 is, yes, it's 6 to 8% since 1926. But is it though? But even if it is, you get 6 to 8%. That's not great. You get 1.5% if you need your dividends. That's really not great. And you still get all the drawdowns for your trouble. That's fantastic. Like I said, index funds are almost half the market. I remember how ignorant and scared I was. I was a normal person, didn't know anything about money. I feel like there has to be a better way. Which leads us to tonight in the Festival of Traders. Takeaway number 2. I'm going to give you a trading system, okay? But the problem is that if you don't trust it. I don't know why you come to the festival. Maybe it's to hear people who are successful give you good ideas, or maybe it's just to get ideas, period. But if you don't trust the ideas that are given to you, then what have you got? Nothing. Everything falls apart. The idea must make sense. And if we're going to go against the establishment, if we're going to try to beat the market as it is, we have to have something that we trust. Because we're taking on trillions of dollars here, so we got to have something that makes sense. Okay, so you're read something online, excuse me, or you're in a festival. How do you trust what they're telling you? Well, you can trust the person if you know them. We probably don't know each other. Hopefully, I know some of you, but we probably don't know each other, so that won't work. You can trust the data. I mean, I buy data. I use TradeStation data, which is reliable to me. I use data for multi-charts that goes through my broker, and I pay for data. I get data from 3 different sources. So I try to give you reliable data because this matters to me. But you don't know that, right? Or you can trust the system's philosophy. And here's the thing. Is this another takeaway? Maybe. If you can listen to a philosophy and it makes sense to you, then it will probably work. If you don't understand what's going on, maybe it works, maybe it doesn't. But if it makes sense, it will probably work. So that leads us to tonight. There are a lot of systems out there. I've developed multiple systems, but this one is the simplest, and therefore maybe it's the best, maybe, and it's counter trend. And I know counter trend trading is scary. Warren Buffett thinks it's scary, and he's best investor of all time. He's a counter trend trader, right? Counter trend trading means if it goes down, it must come up, and if it goes up, it must come down, right? Everything reverts to the mean. Is that a universal truth? I think so. Everything reverts to the mean. So we need, if we believe in reverting to the mean, such as value investing, maybe the most believed methodology of trading there is, this is similar to that. It's similar to value investing, but we're going to use something more concrete, something easy, something much more simple, and that's weekly pivot points, right? Warren Buffett says, get the value of a company and wait for it to go on sale, right? You wait for it to be 50, 60, 70% off, and then you buy and hold it until it gets back to its fair value, and you're rich. Do that over and over again, and you're rich, as long as what you bought is a good company in his words or his methodology, or as long as our fair value makes sense. We can't just pluck it out of thin air. We need fair value so we know what to trade to, and we need it to be reliable. So we're using weekly pivots. You're about to see them on my screen here in a little bit. Okay. What is a weekly pivot then? It's a line on a chart, first of all. From a technical analysis standpoint, it is a line on a chart, but it's a static line. Now, I love moving averages. I've built systems with moving averages. I love them. I've made a lot of money. One of the most profitable periods of my life, I was trading to moving average. Okay, so they are great, but they move. Think about that. You buy something. Let's say you're using a long-term moving average, like a 200-period simple moving average. And you say, thought I'd come back to that average at some point, and price in an extreme situation moves far, far away. And so the 200 simple moving average is at $100. I'm just making this up. And you buy it at 50. That's awesome. Your stock or your instrument's at 50, fair value is at 100. That's a winning trade, right? I mean, that's a winning trade every time. And it is a winning trade. And it's a pretty darn good system, except for what? Your instrument goes sideways or the instrument goes down. If it goes sideways, as it goes sideways, our long-term moving average starts creeping down and creeping down and creeping down. And if it goes sideways or down long enough, let's say it goes from 50 to 45 over 2 years, by that time, guess where the moving average is? Now maybe it's down at 50 itself. Maybe it's down to 49 if you've waited long enough. You bought it at 50, you waited 2.5 years, and now your fair value target is 49. That's the nightmare. Doesn't happen very much. In fact, you can use systems based on that moving average, and most of the time you'll win. But that's the difference in weekly pivots. See what I'm saying? A weekly pivot is a calculation. You take the high, the low, and the close of the previous week on whatever instrument you're using. I'm going to use Forex, but you can use it on anything. And you divide by 3. Right? That is fair, right? Hey, it went high, it went crazy. Hey, it went low, it went sad, and it closed here. Well, let's divide by 3, and you know what? Taking all of that craziness into consideration, this is the fair value for this week. This week, forget all the craziness. This is where we should be at, right? We don't get too high, we don't get too low, and we divide by 3, okay? It's a static line. Now, is that too simple for you? Is it a little bit freaking you out like it did me the first time I learned about weekly pivots 11 years ago? Who cares about this line? This line isn't powerful, right? I mean, it's just a line. It's a high, low, and the close. No complex algorithms, nothing. Well, this can be takeaway. What are we on? Takeaway number 3. Go find pivot points. Calculate them yourself, like I do and did. Don't anymore because indicators can do it for you. Or just go take a look. All right. In fact, go to this SPY. Go to the S&P 500. Where we're talking about the market tonight. And go back to 1993. Now, when price drops below the weekly pivot, right? So now we have a weekly pivot up above. Can you see that? I'm describing it. I'm using my hands. Weekly pivot is up above, and we have bad earnings, and the SPY goes down. See that? It's far away from fair value, far away from the weekly pivot. When that happens, do you know how many times the weekly pivot point level is missed, right? So let's say weekly pivot set up, we do our calculations, and again, it's at 100. Price drops back to 70. Since 1993, how many times has it come back and hit that pivot, right? Now, maybe it's that week, maybe it's next week, maybe it's the following month, whatever. And the answer is 0. Or look at it like this way. 100% of weekly pivots going long, going up, 100% weekly pivot levels have been hit since 1993. So if price went below a weekly pivot, at some point in the future, all of those levels were hit. That's powerful. And I do not expect you to take my word for it. Look it up. Go ahead. Weekly pivots, SPY. It's amazing. I also did it on the Dow going back to the 20s, and there weren't any missed weekly pivots on the Dow either, going back to the 20s. But that's just hearsay. It's just me saying stuff. I'm just telling you, it's crazy. Now, that is going long, so keep that in mind. That was not going short. Okay, now, ooh, that seems powerful. My interest has peaked. Here's a stat. Now, we're going to move into Forex. Why Forex? Because their advantage is 24-hour market, more leverage, blah, 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 blah. I went back to 2016. I just did this by hand. I just did it for fun. 75.5% of weekly pivots touched or got touched on the week they were created. And I just used the pound dollar. Why the pound dollar? Because it's one of the most popular currency pairs and one of the highest volume currency pairs and one of the most famous currency pairs in the news quite a bit in the past couple of years, okay? So since 2016, 75.5%. So it hit that level 75.5% of the time. But think about it. On the week the pivot was created. Think about that. So you're a Forex trader. Sunday opens. You get into the market. Price has moved away from the weekly pivot. I don't know, a certain distance, any distance, a distance you see when you wake up or go to the charts on Sunday. If you're waking up in the evening, then that's another story. We need to have a talk. 75.5% of the time in the last handful of years, that level was hit. So if you just placed a bet, I'm going to bet it's going to hit the weekly pivot this week, you win 75.5% of the time, just that week. Now, in the future, obviously, that rises up. If you could wait a few weeks, and maybe it'll take a few weeks to get back. I was talking in the week it was created, because I'm leading you to my system. I'm leading you right where I want you to go. But that's a pretty high number, isn't it? All right, I've got the fun SPY S&P fact, right? And that is fun, and it's cool. But 75.5% of the time in Forex in the last number of years, and I've done it in various times, and the number always seems to end up in the mid-70s, sometimes up to 78, sometimes 74. Again, do it yourself. I'm just telling you. Price in stocks, obviously, makes sense, especially if you use long weekly pivots. But in Forex, which can go either direction, right, which isn't a company, 75.5% of the time. Now, we're getting to something that maybe we can build a system around, right? Because if it hits it that often, if price moves back to this fair value that often, maybe we can make some money, okay? So where are we at so far? We know that price reverts. Reversion to the mean is a universal principle. Price reverts to the fair value in the form of a weekly pivot a lot, right? And not only does it hit that level eventually, it hits it a lot during the week it was created. So 5 trading days or 5.5 if you're a Forex trader, it's a high percentage target on the very week it's created. Like, people are paying attention to these levels. Somebody is, right? So here we go. Let's get our next takeaway. Let's get an actual system using this. Let's wait for a big move away from fair value, right? We're betting that price hits it a lot, okay? But if it goes 10 points away and then it hits it, and we got a 10-point move, right? Let's wait for it to get extreme so that maybe A, we can get a chunk of that profit, or B, doesn't it make sense that the farther it moves away, the more likely it is to snap back? If it gets way out of whack, isn't it a more powerful move? Well, that's the methodology, and that's what I think, and it seems to make sense. But since we know it reverts back during the week it was created, isn't the beginning of the week the more powerful time to trade? And the answer is yes. The beginning of the week is an extraordinarily powerful time to trade back to a weekly pivot, because the weekend, we had a weekend, you went away to the Hamptons or whatever it is you go on the weekend, and you come back like, there were too many downward news events last week. It's worth more than that. I'm going to trade it back, right? I'm going to buy if it went down, or I'm going to sell if it went up. So we only need to trade the beginning of the week. We got that high percentage number in the back of our heads. We don't need to even trade this all week. And I know that's crazy, but Sunday or Monday, depending on where you are in the world, maybe just Monday, we only have to really set up a trade early in the week. We don't have to even work. We could take trades later in the week, but if prices stayed away from fair value by Thursday or Friday, maybe there's a strong move underway and maybe it's not going to come back, right? So that's our methodology. Let's take a look, right? Again, this is super easy, okay? This is from the dollar-yen, December 2018. The green line is a weekly pivot indicator. I've drawn them on the charts myself. You can draw them too. You just take the high, the low, the close, divide by 3, and there it is, right? I waited for price to move away. So price is clearly, we're in a downtrend. This is clearly counter trend, and this is clearly a stupid thing to do, right? But it's not stupid, because we have a magnetic, powerful target called the weekly pivot. The price moved far away from the weekly pivot earlier in the week on Monday. We're in, that's it. No fancy indicators, nothing. I love indicators, but this has nothing. We have a line right here. We have an order just waiting. Price hits it. Oh, it went against us. That stinks. People came to their senses and said, I needed to go back to fair value, and we get a winning trade. Okay, that's it. I mean, trading 1 day a week, just setting up the pivots, putting our orders in ahead of time. I mean, this is like almost zero work, right? Dollar yen, this is August 2019. Price moved down. Green is the weekly pivot. Gap down. Oh, things are terrible. Look at that movement. That continued, and then people said, no. This is ridiculous. We need to get back to fair value. The key here to this trade, if there is one tricky thing, it can't be touched. Price must move away, and it can't be touched. If price started here and touched it and then moved away, no trade. Because the reason is, if it hits that level once, everyone's done their job, right? Price can go anywhere now, right? Price is concerned about getting back to fair value once. After that, it can go anywhere at once. At least that's the thinking behind it. But notice that this moved down, it moved away. This was our level, and then it made it all the way back to the pivot almost exactly, which is creepy, but that's another trade, okay? How easy is this? And let's give you one more. Dollar yen, it went down. Notice it wasn't touched, hit our level, went sideways. This is a terrible trade, and then hit our target, okay? So we have some stats on weekly pivots. We've seen a couple trades, right? Am I just cherry picking? Like, is it trustworthy? In other words, is this robust? Is this something that works throughout time? Is this something that you can take away from this webinar tonight and use, and it will work tomorrow or next week or next month, okay? So is it? Well, I can tell you it is, but how can we both agree? Well, here's a thing then. This is just, I found this year. I've been studying weekly pivots since I learned about them 11 years ago, but this one just came a few months ago. I ran a test, all right? Again, using trading costs and all that stuff. And I ran it on 16 different pairs. And I ran the system we just talked about. I'll give you the exact inputs in a second. I ran it on a 1 hour time frame, although you can really use anything except daily, right? Because it doesn't matter. We're just waiting for price to hit a level. It doesn't matter what time frame we're in. And notice, they all made money. They were all profitable. Now, you say, well, you know, this is from 2003 to 2019, and the Aussie Canadian only made $5,300 trading one full lot. Big deal. That stinks. I know it's not awesome, right? It's not $1 trillion, but it's profitable. And the amazing thing about this was one of the only times in my life where I ran a system and ran some testing and a bunch of different things were positive. I mean, have you tested systems, right? What happens is, you know, the Aussie CAD's negative, but the CAD yen is great, and the Euro pound is great, but the Euro dollar is terrible, right? And that's perfectly fine. That doesn't mean the system's bad at all. If you study trend following, which is another super popular methodology, there are dozens of instruments that make zero money that people trade. Like trend followers don't even care, right? It's okay for a system to not make money on some pairs. Hey, this doesn't work on that pair. That's fine. You don't trade corn and soybeans the same, or corn and the S&P, right? But this freaked me out because it made at least a little bit of money on all of these. So does that make it robust? To me, we've got a universal theory, and I ran a test and they all came out at least a little bit positive. Pretty crazy. Let's get to some numbers. 16 pairs, all profitable, right? And the number one danger of curve fitting is over optimizing, right? These are all the same. Did I mention that? They all had the same parameters. I didn't change anything. There was no optimizing. That's kind of an important point that I almost stumbled right over. Nice job by me. But think about that. Not only was it profitable on all of them, but I didn't optimize anything. They all had the same parameters. Anyway, and where did I get the rules? Just a little bit of testing and a little bit of common sense. Again, I've been looking at these for a long time. You kind of get a feeling when you've looked at them about how far to go. So let's give you the inputs. Here's the system. Wait on Sunday/Monday. Wait till it moves 114 pips away from an untouched weekly pivot. Super important, okay? And then you just take the trade immediately. I do it with robots, but you could have the pre-orders ready. And here you go. 20 pip target, 110 pip stop loss. Oh, that's way terrible risk and reward. I'm just telling you, right? It's a high percentage target, so give it room. That's what the numbers say. I mean, you saw, you know, a bunch of profitable currency pairs. And I use GMT plus 2 time, which means just trade Monday. You can trade it Sunday, Monday if you live in an Eastern time zone. But if you are a time zone expert, GMT plus 2 only Mondays. That's it. 1 day a week. Okay. Big deal. Neat system, right? How does that compare to the market? Well, I ran figures. I got this online from April 2003 to 2019. The market made a 6.9% per year, or 193% overall. Now remember what happens if you spend your dividends on life. It only made 4.9 with a max drawdown of 51. Okay, so those are the numbers we're trying to beat. I know nothing beats the market, but that's what we're trying to beat, right? I thought, well, what if I trade all 16, right? Wouldn't that be cool? Like, I know all of them weren't great, but what if I traded all of them? Well, I went and did all my homework, and I said, okay, well, how big of an account would I need if I got into all of those trades at once? So if I got into 16 trades at once, which will not happen, period, but if they were all in a trade and I wanted to have an account big enough to actually take them, I'd need about a $60,000 account, okay? So let's do the math here, ready? It made 195,000, right? If you add up all those 16 pairs, so 60 plus 195 is 255. Again, check my math. I'm not trying to trick you. I'm just trying to give you information, okay? That's 326% return. That divided by that, that's bigger than 193, right? And according to my calculator, that's 10.1% per year, and that was 6.9 with dividends, okay? Right? But that's idiotic. There's no way all 16 pairs, I mean, they're different currency pairs. There's no way all of them are going to move that far away at the same time. So what's fair to say? Well, let's say there's only 12 of them, right? And again, that's ridiculous. Probably about half. You might be, if you traded 16 pairs, you might be in 8, maybe 10 at once, okay? But it would have to all happen at first on your very first trading week to have a trade be negated because you don't have enough margin, right? So think about this. These numbers are conservative. I told you that, right? So let's say only 12 trade at once. Well, if you only trade 12, then you'd only need about a $50,000 account. So then you have to redo the numbers. Well, same amount of profit on a smaller account means you make more. 390% is better than the market over the same period. You can see that's 11.2. Now that is no compounding. Guess what happens if you would compound every year? I'll brush over that at the end, but the answer is more. It would make more if you compounded it every month, every year, however you like to compound, okay? So just give you a rough estimate. In this time period we're talking about, $10,000 in an index fund would turn into about $29,000. Again, always check my math. At the worst case scenario, using the full portfolio and using margin for all of it, 10K turns into 49. If you use a smaller portfolio, it's higher than that. Is that better than the market? Is it simple? Is it trading 1 day a week? It's crazy, right? Isn't it crazy? Here's another example, right? We hadn't seen any short trades. Here's euro dollar, August 2019. Oh, that's recent. Again, weekly pivot, euro dollar, price moved away, 114 pips. And it dropped down for our 20 pip target, right? And then life went on, right? See, when you only go for a small chunk, when you don't ask it to go all the way back, the percentages go crazy. What's the winning percentage? High 80%. Again, do your own testing, but I'm telling you, it's like 88 to 90%, depending on what you're looking at. The winning percentage is crazy. 1 day a week, right? It's crazy, right? And here's another one. I might try to show you everything. This is a CAD Swiss in 2018. So this is a while ago, a year ago. Price moved away, right? Gapped up. Now this can happen. Absolutely. And I want to bring this up. If you're interested in this type of trading, price moved away and did nothing, right? Didn't hit our stop, but did nothing. The next weekly pivot comes in. I don't care. The system does not care. You take this trade and you keep it until it's done. Either it stops out or you get your profit. So this new pivot meant nothing. And if this lasted longer, then you would just stay in the trade. That's a question I get asked a lot, and there you go. There's an example for it. Okay, so that's done. There's your takeaway. 20 pips you saw, 114 away, 20 pips, 110 pips stop. Well, it was nice on that last example, but couldn't we go for more than 20? Well, you can. What's the other end of the spectrum? Because I tested all of this because I'm just fascinated by weekly pivots. What if I did the portfolio, but I did a 150 pip target? So went not only back to the weekly pivot, but I said, because the pull is so magnetic, it's going to pull it and it's going to keep going. This is a ridiculous number, but here's how it worked. Now notice we have some red. In this portfolio, the Aussie Canadian did not like that big profit target. That's asking too much. Your Aussie hated it and so on. But look, the ones who liked it, loved it. This portfolio actually made more money when you go for more. Now it's 17 pairs, keep that in mind. And the average drawdown, again, all I did was average, right, was 58%. That is much larger than our 20 pip. But we've got 4,700 trades. I mean, we've got a bunch of different currency pairs, and we've got lots and lots of profit. Could you just choose not to trade the ones with a low ATR? Maybe. That would probably kick this one out, probably kick the New Zealand Canadian out, probably kick the dollar Canadian out maybe, and then you'd make even more money. I just wanted to show you what it looks like when you kept everything else the same, 1 day a week, 114 entry, but you went for 150 with 110 pip stop, okay? Now here's an example of what that looks like, all right? So not like this system's complicated or anything, but this is a little bit, this takes a little bit different style of trader. Okay, Price moves up, right? It was moving up the week before. It hit the notice. Market opens, does not hit. And price rises to our preset level. Again, if it's an automated strategy, it's right there. And if you have a line or pre-order, it's there too. Price kept going, but then it's like, no, I need to go back. But not only does it need to go back to the weekly pivot, we wanted it to go even farther, considering if it corrected this far, maybe it'll go a little farther. And indeed, it did. It went a lot farther. But this is from August 2019, and there's a trade with a long profit target. So you can see the pull. You could have gotten your little 20 in here, right? But you also could have gotten much more, or something in between if you'd like to tweak it. Okay. Well, where did I get 114 pips as an entry? Well, I'm just telling you, anywhere between 74 and 114, 15. They all kind of work, but I just wanted to show it to you. Here's a portfolio. If I only weighted 74 pips, why is it 74 and not 75? I'm just being obnoxious. I don't really have a good reason. Okay? But instead of 114, everything else the same, 20 pip target, 110 pip stop. You did 74. You got some negativity, right? You got some losers because we're getting in before price got extreme, perhaps. We still made money, but not as much money, and the drawdown was about the same. Now, we get tons of trades though, so sample size is good, but you can see by waiting for longer, you get a little bit more profit and a little bit more wins, okay? Now, last thing of the night, again, this is blurry, but I couldn't make it better, I tried. What if you say that's 1 day a week? Well, what do you do in a situation where you don't trade for weeks at a time? That can happen, right? If price keeps hitting the weekly pivot or doesn't move away, you can go a long time without trades. Every system has a downside. That's a potential downside. But could you trade something like this all week? Now, we talked about maybe later in the week is not as powerful. Well, here's one, right? Again, use it for something that's useful to you. Pound dollar, we switched, one of my favorites. This trades all days, Monday, Tuesday, Wednesday, Thursday, Friday. I did not wait as long, 80 pips to enter. And I went all the way back to literally the weekly pivot, all the way back to fair value. So 80 pips entry, you're going for 80. We kept our stop loss pretty wide. Now, one thing here, the others did not ever move to break even. If you get 70 pips of profit, put in break even. Doesn't happen a lot, but there's no way we're going to get 70 pips toward the pivot and then lose that trade. So 70 break even. This is from 2007. It made 25,000. Max drawdown was 59.85. Sorry if you can't read that. That's 24,997, 59.85, and the winning percentage was in the 50s. Okay, so that's all week. Still pretty good. Here's the equity curve from 2007 to 2019 of what I just showed you. Yes, of course it loses, but look, it's pretty nice left to right. So all week isn't bad. And here's an example of the trade. Price moves away, 80 pips away. You can see it goes all the way back to the weekly pivot. So that's all week. Which do you like better? Wrapping up, counter trend trading can work. It's not always easy, it can be scary, but we have a good reason. I gave you stats and I gave you reasons, so we can feel pretty confident. Buying on sale clearly is not new, right? This is nothing that's fantastic or anything about it. Win percentage is high if you use a 20 pip target. 6,000 trades we've seen. Beats the market with less drawdown than the market. If you compound at the end of every year, you can make up to 25% per year instead of 10%. So keep that in mind. I didn't compound, but it gets into the 20s. Definitely, it gets into the 20s if you compound. And of course, you can optimize. Again, I use the same parameters on everything. So you can do whatever it is you like. I'm just giving you something that tested out nicely, okay? People always ask me, I've given this presentation and not even talked about the robot that I use, but of course I have a robot. It's every robot that you buy from me is $449, but I love the festival. So if you want to get it for a discounted rate, it's $299. That's my sales pitch. It's 4 seconds long.